So I do think that stablecoins are going to continue to be around for a long time. And I do think that they somewhat pressure kind of the Bitcoin narrative. But I think at the end of the day, Bitcoin has that decentralization aspect. It has that long-term capital aspect. And I think not until Bitcoin is much larger and less volatile would it really kind of catch on as something that people regularly pay with. But when you look at like say River Finance, like when they do analysis on Lightning Network and volumes, the volumes are actually pretty decent on Lightning, for example. There is volume happening. There are billions of dollars of transactions happening, just not the trillions that many people would have maybe hoped for.
The current economy's unequal growth is one of its main characteristics. The GDP is growing overall, but the gains are concentrated in a few sectors, such as government-sponsored industries, defense, and artificial intelligence. In the meantime, a large portion of the economy is stagnating, resulting in a K-shaped economy where certain industries and individuals prosper while others face difficulties. This picture is heavily influenced by fiscal deficits. They directly inflate GDP figures, making growth appear more robust on paper than it actually is for the majority of people. Because of this, it is more difficult to analyze standard economic statistics because analysts must take into consideration the effects of significant government spending. For Alden, understanding inflation starts with energy. Historically, major inflation spikes have happened when oil prices are high. As long as energy is flowing freely and remains affordable, inflation tends to stay under control.
Yeah, one of the tricky things is that the GDP growth we're seeing is very concentrated, and the deficits are they feed into the GDP calculation as well. So basically, anything that's kind of focused on AI or on the receiving side of deficits is generally booming. Whereas the long tail of other things is, the classic K-shaped recovery that it's called, or two-speed economy. That's very real. The short answer is, long as energy is flowing and there's no bottlenecks, that does a lot to keep inflation down. Almost any kind of major inflationary cycle in history usually has high oil prices associated with it. So anything that either the administration or globally can be done to make sure that oil is not the bottleneck and natural gas is not the bottleneck and power is flowing in general, and pro-nuclear type policies, whatever the case may be, depending on the country, that's the place you can get to where you have pretty high growth with inflation that's at least under control. And so really, when analyzing if inflation's going to come back or not at scale, I think you start with the oil market and go from there. I think people tend to like money printing when the printing goes toward them. Right. So, for example, during the whole stimulus and the aftermath of the lockdowns and stuff, industries are trying to make sure that they're getting, bailed out. And so I think that it's one of those tragedy of the commons situations where, everybody suffers from the debasement, but not everyone suffers from it equally. If you're in finance, it's like people here, you can short the fiat currency and be long assets, and you can actually benefit from debasement. Whereas people who, they work every day, their salaries are denominated in dollars. That's a friction that they have to go through every time they're trying to get a raise, every time they're saving. But I do think that, going forward, the reason the deficits exist is because people want them, and they're all fighting over the pie to make sure that they're getting it. Right now, it's going toward healthcare. It's going toward the aging demographics. The top heavy social security system we have. It's going toward defense. To the extent that we do get job losses from AI, if we get a more pessimistic scenario where we do get kind of pretty weak labor market. I think that you'd see more people clamoring for answers from their politicians. And if it hits a critical mass, then that's an avenue of money printing, and that's a whole nother part of the deficit that I think we'll see. Well, I think it is I think the biggest factor is it is a productive force. So over the, call it 5-10 year period, as we discussed earlier, it does weigh down on aggregate inflation. Even if other things go up, for example, if the cost of power goes up, or eventually we have another oil bull market and that gives us some inflationary pressure, it is a deflationary force on white collar work. If you look over the past 25 years, most of the reduction in inflation we've seen is mostly in manufacturing, electronics, textiles, things like that. And that's where the combination of offshoring and automation has weighed down basically, blue collar deflation in a sense. And what this does is it kind of puts that same sort of force we've seen over the past 25 years into white collar labor. So things, accounting can be way more efficient, and translation can be way more efficient, and editing can be way more efficient. And it kind of goes up the stack from there. And that's, in the US, it's obviously tens of millions of jobs that are impacted. I tend to be an optimist in the sense that obviously it's disruptive when it happens, but I think that people adapt. And I think that, productivity is a good thing. When they invented the tractor, it's not like, it was a apocalypse of farming jobs. It's just that every farmer got way more efficient at farming. And then some of them, obviously, as generations went by, could go into other fields. So instead of having 6% of the population work in farming to feed everyone, 1 or 2% of people can work in farming and feed everyone. And I think we have a similar thing kind of ahead of us for white collar work, which is the whole back end of a business can just be way lighter because you have a smaller number of people overseeing the bots do a lot of it, which frees up them to work on other things, and that they have more abundance. Obviously, the big risk factors are in the concentration of gains that come, how societies deal with this. So I do think that we are in a period of heightened, polarization that we're going to be for the foreseeable future. But I think ultimately productivity gains are a good thing. Well, I think in recent times, the changes we're seeing with the balance sheet and rate cuts, that's not fueling inflation because it doesn't really fuel money supply growth. Even things like tariffs, they're not particularly inflationary in the broad sense because they're not impacting the money supply. They can just around the margins show up. They can obviously increase the price of one thing. They can also reduce the demand and therefore reduce the price of other things. So it just kind of shifts things around. I think right now we're in a transitional phase in macro, which is we're exiting balance sheet reduction, going toward balance sheet increases. But the numbers are not large. That this isn't, COVID printing that people think of now when they think of QE. It's more of a steady state. And then we're also in this, because we're in a period of fiscal dominance, a lot of the traditional metrics just work differently now. We have these larger average fiscal deficits, which injects capital constantly into parts of the economy. So senior spending, basically anyone who's on the receiving side of the deficit. So the Defense Department, all the contractors there, the healthcare system, Social Security spending. That's where the capital is going into the economy, and of course other parts are squeezed. So we're in this like holding pattern, and as long as energy is flowing and cheap, right? So as long as oil is not a bottleneck. That keeps a lid on inflation. And so they have quite a bit of runway, I think, to go forward with probably some rate cuts. And I don't think the balance sheet expansion will be particularly inflation in the next, call it year or 2 years. Yeah, so I think inflation's a spectrum because it doesn't show up evenly, obviously. And there's a pretty simple calculation, which is you have the debasement rate, basically money supply growth, and then you have some amount of productivity growth. Right now, obviously, AI is a big factor, but over time, it's automation, it's everything, all of our technology, all of our organization. We're billions of people every day are trying to make things cheaper, essentially, and finding new ways to make things cheaper. So you have that, let's call it 7% money supply growth over the long term, and then you might have 4% productivity increases every year. So that difference, roughly speaking, that 3% in a longer term pattern is the price increases. And around the world, central banks are basically doing their best to counteract the deflation that we would get from productivity growth with that money supply increases. But there are periods of time where we don't get much more productive in a given 5-year stretch. It could be because there's energy shortages. It could be because there's war or something like that. And other times you're in that period where productivity is flowing. And then as that money supply growth happens, it doesn't show up everywhere equally because we're not 4% better at making gold this year. We're always just marginally better at making that. We're not better at making Bitcoin this year, obviously. And then, you go down the stack from there. So we're not, every year we're not way better at getting more oil out of the ground. We're a little better. We're not way better at making houses. We're a little better, but we are exponentially better, for example, making software. We're exponentially better over the several decades of making electronics. So when that happens, when you have that kind of longer term money supply growth, it shows up in the assets that we're not getting better at making. Same thing with the best stocks in the world. We're not getting better at making NVIDIA stock, for example. And that's where all that debasement capital shows up. And then the long tail of things that we're way more abundant in, they get cheaper and then they weigh down the CPI basket. And that's what allows the central bank to be pretty dovish.
Lyn Alden approaches the market from a structural perspective, focusing less on short-term noise and more on the long-term shifts happening beneath the surface. She highlights how the global financial system is gradually evolving, where persistent deficits, rising debt levels, and changing liquidity conditions are beginning to reshape investor behavior. Rather than sudden panic, what we are seeing is a slow but meaningful transition. Capital is starting to move more carefully, with investors paying closer attention to real assets, monetary policy, and global currency dynamics. What stands out in Alden's analysis is the idea that these changes don't happen overnight. Instead, they build quietly over time. Small reallocations, whether from institutions, governments, or individuals, can eventually create powerful trends. As confidence in traditional systems fluctuates, diversification becomes more than just a strategy. It becomes a necessity. Take a moment to like this video, subscribe to the channel, and turn on post notifications so you never miss an update. Thanks for watching and enjoy the video.
And I think broadly speaking, the kind of the lack of the crypto cycle this time probably weighed on it. I'm on record not being, I'm pretty bearish on the broader crypto space structurally, but they tend to have a lot of capital. And so they kind of fuel some of these cycles. And they didn't really have a season at all, this particular cycle. And I think if anything, they are weighing on kind of the quote unquote brand of Bitcoin. When people, when media and in general, when people talk about Bitcoin, they lump Bitcoin with crypto. So they think of meme coins, scams, the broad array of issues. They think of losing money when they think of that. And I think that's going to weigh it down probably for a period of time. There's still something like $1 trillion in crypto market cap that I think is overvalued. And I think it is kind of a gradual stagnation. And, it'll have cycles up and down. But that's kind of just an anchor, I think, around the real story, which is basically Bitcoin and stable coins and, a small tail of other things, tokenization in general. It's always surprising how things can happen all at once. So I've been in the gold bull camp, but for example, if you would have asked me a year ago, would we have seen $5,000 gold by now? I would have said wouldn't be my base case. And of course, once gold runs, you get runs in silver and platinum with a lag. I mean, I think most of the narratives we see around it are at least directionally true, which is that we are seeing countries diversify, in percentage terms away from treasuries and toward gold. No major sellings going on, but there's like the marginal interest is more in stacking tons of gold. And then you get momentum building from there. And so if you look in history, kind of the US stock market had kind of four main bear markets against gold, right? So when we price things in dollars, it's always tricky because dollars themselves, that we just discussed, are debasing. When you price S&P 500 in shares of gold, in ounces of gold, we've had kind of four major bear markets over the past, call it a little over a century. I think right now we're in the fourth one's going on, right? So equities, although there's many good ones, they've been debased pretty heavily against the money supply. And globally speaking, there's just been an influx in demand. Lately, Bitcoin is almost perfectly correlating with like the software stock indices. Like everyone's pointing out that ETF, IGV, I believe it is, and it's almost a one-to-one correlation. It could be the algorithms doing it, but really no way around it. There's just not been a lot of retail demand for Bitcoin this cycle. It's almost all been in the corporate sector, all been in the institutional sector. To the extent there is retail demand, it's mostly been in higher net worth retail that have brokerage accounts, that they have access to the ETFs now. And so right now there's not a lot of retail buying. The interesting thing is that as euphoric as precious metals got, the retail only really came at the tail end of it. So when Bitcoin was when gold was in a kind of a shadow bull market, maybe 18 months ago, there really wasn't much retail participation. They only came in on the tail end. And I think Bitcoin just this cycle pretty much lacked retail. Basically, stable coins, they attach the existing network effect of the dollar, and to way lesser extent other fiat currencies. They're almost all dollar stable coins. And when people are using money for shorter term like working capital, volatility is something they want to avoid. And so I think basically as long as people have liabilities denominated in dollars, so whether it's debts or whether it's things that other things they owe in the future, whether their paychecks are denominated in dollars or other fiat currencies, there's going to be interest in stable coins. I think that market cap is going to keep getting higher, call it for the next 5 years, and we'll see how that goes. And also every Bitcoin transaction is taxable, right? So I think, it would go a long way to have kind of a de minimis exemption on Bitcoin capital gains to make it more flow as money. And then in addition, one of the downsides of stablecoins, of course, is that they can be frozen when they are centralized. But the vast majority of people, especially for their working capital, they don't lose sleep over that. So I do think that stablecoins are going to continue to be around for a long time. And I do think that they somewhat pressure kind of the Bitcoin narrative. But I think at the end of the day, Bitcoin has that decentralization aspect. It has that long-term capital aspect. And I think not until Bitcoin is much larger and less volatile would it really kind of catch on as something that people regularly pay with. But when you look at like say River Finance, like when they do analysis on Lightning Network and volumes, the volumes are actually pretty decent on Lightning, for example. There is volume happening. There are billions of dollars of transactions happening, just not the trillions that many people would have maybe hoped for.
According to Lyn Alden, the concentration of growth has become one of the key characteristics of the modern economy. GDP growth does occur, but it is primarily concentrated in industries that directly benefit from government spending, such as artificial intelligence and defense. As a result, the economy becomes two-speed, with the recipients of fiscal deficits prospering while the rest of the economy finds it difficult to keep up. Crucially, fiscal deficits are included in GDP, which can make economic expansion seem more robust on paper than it actually is. Alden also emphasizes how productivity increases, particularly those brought about by automation and technology, have long-term deflationary impacts. Manufacturing, electronics, and textiles have had the greatest declines in inflation over the past 25 years due to cost reductions brought about by automation and outsourcing. Ultimately, Alden's view is that the current macroeconomic environment is complex, shaped by concentrated growth, energy availability, productivity advances, and fiscal policy. Inflation isn't simply a result of government spending or rate cuts. It's a balance between how much the economy produces and how much money is flowing. Understanding these dynamics is crucial for investors, as they show why some sectors thrive while others stagnate, and why careful analysis of energy and productivity trends is essential for predicting inflationary pressures.